with StanChart Securities. Dheeraj, morning. Thank you for joining us. Dheeraj, in last 3 days, Indian markets or stock prices have reversed. So do you think we need to pay importance to that, or what we've reported in last 3 days is a simple profit booking and a good opportunity for dip buyers?
I would think bulk of the easy rally is already played out. That doesn't mean that we are headed for a big crash yet, but I think the markets become a bit too cheap end of December. Also, some of the environmental factors or global factors reversed positively at the start of this year, including fresh injection of liquidity in Europe, etc. Bulk of that is already played out. It was too fast, too soon, but roughly 5,500, 5,600 is where I would say markets are no longer in the distress zone. So from here on, for any significant upside for the market, the real fundamentals, policy making, some real action needs to be seen. So my bet is that we stay in sort of a range for some time before things become clearer.
Dheeraj, what are the sound bites or pulse you're getting from some of your institutional investors? Because the big hallmark of this year's rally has been global liquidity, and if I map how global liquidity has moved, foreign institutional investors have pumped in about $6 billion so far this calendar year.
Yeah, so I mean, you pretty much said it. Money has come in. There were people who were underweight, but also remember that a bulk of the money which has come in has come in through ETFs, not really active funds. So a lot of macro money has been put at work because of surge in liquidity and the reversal of sentiment. The real long-term fundamental oriental players at this point of time are thinking hard whether things can actually turn up. Remember that last 12 months we have seen continuous decline in IIP growth, continuous degradation of forecasts of GDP growth. As of now, there are hopes things will revive, but a lot more needs to be done. So I think we've come back from whatever the cheap valuation zone to a reasonable valuation zone given the current macro backdrop. From here on, it's going to be more about how the economy does, how the earnings estimates pan out, etc.
Okay, there's a sizable block deal which has happened on the BSE and Gujarat NRE Coke. Almost 50 lakh shares have traded hands. I want to see the price as well of the block deal as to what code it has been struck at. 7% uptick coming in for Gujarat NRE Coke currently in trade at the price of 23.10 as well. Dheeraj, just want to get you in on crude. I mean, how important a trigger is it currently for the market sentiment, and it being above 150 on the Brent, how worrisome is that?
I think it is quite worrisome. What level is worrisome is obviously a tricky question. To try and answer that, let's look at history. I mean, 2011 average Brent was $111. Take about 7, 8, 10% volatility on each side. So I think 100 to 120 range is okay, because I mean, we have pretty much absorbed an average of 111 for 2011. But if Brent stays above 120 on a consistent basis, maybe add another $5 or $7 sort of a cushion out there. If it stays above 125 on a consistent basis, I think we will start struggling again, both in terms of trade deficit, in terms of capital account deficit, in terms of the eventual pressure on rupee report, irrespective of the foreign dollars which is coming into the markets at this point of time, and obviously the oil subsidies. So I don't think it's a factor which can be ignored above a certain range, and in my mind that range is about 125, 127, in that ballpark. So it is a risk. It's a risk for our economy and hence the markets.
Dheeraj, what about RBI action in terms of the monetary stance? I mean, could we see a rate decline come this policy onwards by the month end?
Our bank's house view is no. Bank's house view is maybe the next policy. We are looking for another CRR cut perhaps in March and repo rate cut only in April.
Dheeraj, if I take the clock back to November 2010, the time when the QE2 program started, first everybody celebrated that yes, US Fed will print more money, equities went up, commodities went up, but after that all inflation fears, they started ballooning up. Now that European Union is for printing more money, do you think somewhere in the middle of this year inflation fears will haunt us back?
It's quite possible. I wouldn't rule it out. And the behavior of crude prices, which is a combination of both easy liquidity as well as the Middle East tensions, is perhaps a precursor of that. So when the cycles have become shorter in this world at this point of time, economic indicators or parameters have become a lot more volatile, and they move up and down in a much larger range as compared to ever seen before. So very quickly moving from a low inflation to high inflation back to low inflation is something which has been happening, and I won't rule it out happening again. So these are the risks we have to be on our toes for. So while easy liquidity is good for equity markets because a lot of it comes into equities, it also gets attracted into commodity markets, which is negative for inflation.
So at Standard Chartered, after a 20% run-up, what are your top ideas for, from the large cap basket?
We are preferring, in fact, our strategy team put out a note just yesterday. We are preferring to move a little bit towards the defensive after a huge move, just tweaking the top buy list a little bit in terms of reducing the weightage on industrials, reducing the weightage on some of the other high beta names which have run, including metals, etc., and moving it back into slightly more safer names like FMCG, etc. at this point of time. Our top ideas have broadly remained consistent. We've been very positive on levers, ITC, Bajaj, Tata Motors, ACC, Bharti, and we have a little bit of peppering of a few high beta names like DLF, etc. in the portfolio. But yes, after such a big run, 20% at the market level, 40 to 60% at the stock level for many of the stocks which are beaten down brutally in the last quarter of 2011, I think one needs to move a little bit back more towards the defensive.
So Dheeraj, what are the spaces that you would completely avoid, even given the assumption that the market would ride higher from here onwards? What is it that you would completely avoid, and where do you think that the pain would continue to persist?
These kind of markets are very stock-specific markets. So I would not put all my money on one sector or write off one sector completely. I think you will find stocks to bet on in every sector, similarly stocks to avoid on in every sector. If you take last year as an example, you analyze the intra-sectoral performances for any sector, you'll find the gap between, and I'm talking just large caps, if you don't include mid caps as well, you'll find the gap between the best performing large cap for a sector and the worst performing large cap for a sector as wide as 30 or 40%. So to answer your question, there is nothing on a don't touch list. There is nothing on put all your money in here list. It's going to be a very bottom-up market for quite some time to come, and I would recommend just focusing on individual company fundamentals.
Okay, let me get specific then, Dheeraj. What about the private sector players, power players that is? Is it time to buy them on dips if you had faith in the fact that fundamentally things are actually improving for the sector, there is a lot of policy action as well being undertaken, and that fundamentals of these companies are genuinely going to improve?
Are you talking about power developers? Or
that's right.
Players?
Developers.
Power developers we don't cover at this point of time, so unfortunately I'm a little out of depth. But yes, there are some positive policy moves which should ease problems for private power developers. We still need to see how much of that actually translates into action. But purely from a macro perspective, I think sentiment in that sector, and hence some of the structural problems in that sector can probably get solved, so it should be positive.
From a medium to a long-term perspective, Dheeraj, do you like Maruti, which is more like a domestic play, or do you like Tata Motors, which is now 80% a global play?
We like both. So,
which is overweight and which is neutral?
Yeah, we are overweight on both.
So what is that?
We like both the stocks, and exactly for. They're two very different companies. So apart from being forced to choose one out of the two, as you rightly said, Maruti is a pure domestic play coming out of a sort of a very troubled times because of strikes, etc., and hence gaining back market share. That's on one hand. Tata Motors on the other side has done a fantastic job with JLR in terms of finding new geographic areas to sell into, to continuously launch new products to generate the excitement, which is keeping the sales up and strong. Also should benefit domestically with the rate cuts on the CV business itself. So, apart from the fact that they are both so-called automobile space, they are very different companies now, and we like both.
Dheeraj, is it time to go long on oil exporters if you were to hedge your crude oil risk?
Oil exporters as in?
Talking about companies like Ken, Dheeraj.
I'm not sure if I got that question right.
I'm talking about companies like Ken, Dheeraj.
Ken has done very well. Ken has already done very well. So a lot of rising oil prices already built into the stock price. It can rise a little bit more if oil continues to rally, but I would doubt if it has a huge amount of upside left, because end of the day the valuation would also come into play. So I think it already discounts, according to our sort of rough estimates, an oil price of $125 or $130.
So, Dheeraj, exactly after 6 months, if you and me are engaging in a conversation on the same forum, do you expect markets to trade higher or lower?
It's trade higher or lower from today. It's a tricky question. All that I can say is that 6 months down the line, I don't expect the market to be more than 10% higher or 10% lower from here. So I am looking at a prolonged period of range-bound market, and that prolonged period might not be just 2012, it may also include 2013. I think there are structural problems in this country which needs to be solved. For that, we need very solid policy making. I don't see all the structural problems getting solved in a big hurry. So the market, I think the market is very similar to what we saw in the mid to late 90s, in a 20 or 25% trading band. So we will rally up, we will sort of get depressed about some of the negative factors again and then come down. So, broadly, if you ask me to put a range, 4,500 to 5,600, 4,400 to 5,800, that's probably the range I think the market would trade in. So I'm more convinced about the fact that it's a range-bound market rather than giving an exact number that 6 months down the line will be either 5% higher or lower.